Well, good afternoon from here in London, and welcome to another FS Club event. And I'm delighted to be sharing this event with you online, but in particular, our dear friend, Dr. David Doyle, a very, very regular visitor on this program since 2007, is here again today to give us an update on the EU financial services regulatory agenda. Of particular interest to me, not least, is last night President Macron pledged friendship for mutual benefit at the Guildhall during his state visit to the United Kingdom. So we're very much looking forward to perhaps some of the effects that might have. But anyway, as we move ahead, we can see here a list of our sponsors, and I cannot emphasize enough how thankful we are to you to let us wander widely and freely across finance, economics, technology, and science as we do, with the odd strange thing thrown in. But today is not strange at all because David is back because he is a very, very popular and regular presenter and calling in from the heart of the EU and giving us an update on what is ahead. So, as we have a quick look at the program, a few points of housekeeping. I'm going to be out of the way as quickly as I can so you can hear from our expert. David will be speaking for approximately 20 minutes, but hopefully end sharp at 3:25 so that there's a good solid 20 minutes of time for Q&A. So, points of order. One, yes, this is being recorded and it will be posted in a couple of days, and you will be notified, and feel free to share with friends and family if you've got nothing to do on the weekend. Secondly, uh, I would like to point out that the chat facility here in the GoToWebinar is really the thing to use, and I will be feeding those questions or summarizing some of those questions for David during the discussion. So after the first 20 minutes, the quality of this event and its success depends on you and your questions, comments, and observations. David will be receiving a full copy of all the questions and comments, so if you want to get in touch with him, just say so in the chat facility, and he will be sent your comment plus your email. So that's it. I'm here with you online, so there's no point in WhatsApping, there's no point in WeChatting, there is no point in signaling, there is no point in texting me, no point in emailing me. Please use the chat facility. It is the best way to pull this together, and it is fun and friendly. David, you have been a real star in so many ways over so many years, and you have called so many things on the EU right. We live in awe. Over to you.
Thank you, Michael, and welcome everybody to this particular session. Look, I want to start by saying that it would be a gross understatement on my part if I did not indicate that this particular mid-year regulatory update is very much colored by the geopolitical events that have occurred over the last 6 months. But all of those have accentuated since the 2nd of April, when the US presidential announcement of wide-ranging tariffs by the US on trading parties, not to mention the escalation of conflicts in the Middle East, all driving volatility in the financial markets, has led to EU companies and investors having to say the least, navigate a more perilous geopolitical environment certainly since the 2nd of April. A more cautious approach is very noticeable, by me at least, in the boardrooms across mainland Europe, corporate Europe, as everybody awaits yet another announcement from the US, I think in the next 24 hours, if my intelligence is correct, as to what tariff deal will be applicable to the EU. So this very cautious approach, or this cautiousness, is not shared by the European institutions in Brussels. Faced with these massive challenges, the European Union has embarked on a quadruple transformative imperative. But you know, long before the US elections, Mario Draghi, the former Italian PM, and of course the former European Central Bank president of whatever it takes to preserve the Eurozone fame, was warning as early as November last year, the EU heads of state, the European Commission and MEPs, about the significant loss of EU competitiveness in the face of fickle trading partners, stronger economic competitors, in a world of fast-moving technology, particularly from the other side of the world. Add to this the somewhat ominous prognosis on the need for Europe to invest billions in the rearmament of the 27 new member states, with Germany leading the way recently with a €500 billion defence infrastructure investment plan, and yet in another departure from usual policy, all exempted from Germany's very strict debt rules. Now, all of this, I think, is perhaps best encapsulated in a rather blunt statement, to say the least, this week by the European Council President, Antonio Costa, to the European Parliament plenary session, where he said there were three fundamental priorities which will mark the next couple of months for the European Union in terms of legislative action. One, obviously, competitiveness. Secondly, defence. And thirdly, Europe's role in the world. He went on to say that the conflict that we're going through so near Europe demonstrated, and I quote, that peace without defence is an illusion, end of quote. So the dice have been thrown and there's no going back. And quite visibly, the European Commission has embarked on some very game-changing measures which look at fostering deeper capital markets in Europe, which is a long-standing ambition even during the Capital Markets Union initiative, boosting innovation, and also mobilizing increasingly citizen savings into the EU capital markets. So let me just pause there and say to you that, actually Europe saves much more than the United States. EU citizens save about 15% of their disposable income. That's 3 times more than in the United States and in other parts of the world. But most of them, if I listen to the likes of Mario Draghi, the European Central Bank, the European Commission, and other economists, most of it is held in low-risk, low-yielding bank accounts, unlike the US, where holdings of equities are 4 times that of the European Union, and that also includes the United Kingdom, where only 8% of people actually hold equities as part of their overall portfolio. So the idea is to galvanize and mobilize and channel all of these savings, 13 trillion, according to recent figures, languishing, in the words of one economist, in bank accounts that could be better redeployed to boost competitiveness and innovation in European industry. Secondly, continuing towards the decarbonization of the EU. We haven't forgotten this, except with less onerous reporting requirements, notably in the area of the EU ESG and sustainability finance platforms. Thirdly, bolstering competitiveness, a la Draghi report from November 2024, where he believed that there was an urgent need to eliminate inconsistent and restrictive regulations. Fourthly, perhaps reducing excessive security dependencies, something that comes home to us all on a daily basis from non-EU sources, and notably ensuring that we have technological sovereignty in terms of the 27 new member states, and building an extensive network of trade agreements, which have already been accelerated quite spontaneously and very assertively by the European Commission, which includes many countries in Latin America, India recently, and Southeast Asia. But the immediate concern that also troubles a lot of industry in Europe that I speak to comes from the other former Italian MEP, Enrico Letta, who in April of last year pointed to the very ominous trend of companies increasingly and investments increasingly in Europe leaving Europe for other parts of the world, notably the United States, again due to the overly complex and bureaucratic nature of the regulatory framework. And he referred to the fragmentation of the single market which means we have some structural threats that we need to address immediately. So my prediction for the next certainly 6 months and perhaps beyond that, in terms of where the EU regulatory agenda is going and what will be the core orientation factors that will drive this. Well, number one, reduced complexity of reporting requirements for financial entities. And this is not just about ESG and sustainability finance. There's some talk about also reducing the scope, reducing the quantity, the quality of some of, and the duplication that's experienced by many banks under the Capital Requirements Directive and regulation. Also taking into account a more accommodating prudential regime for non-banks to invest in European industry and notably SMEs at a time when we still struggle with an over-reliance on bank funding throughout Europe to fund the real economy. Extraterritoriality characteristics. This has been a feature going back to DORA, the Digital Operational Resilience Act, and also the more recent Artificial Investment Act. What we're seeing is increasing integration and cooperation of third country type issues. In other words, if you want to play with the big boys in Europe, you need to set up a capitalized subsidiary or a branch in an individual country with a proper license issued by that particular state. Now, if you're looking for an example of this, look at the separate new chapter within the Capital Requirements Regulation, version 3, which relates to the setting up of third country banks, bank branches in particular, which means that essentially from 2027 onwards, foreign banks will not be able to provide remote-based banking services, particularly to the European Union, particularly as it relates to deposit accounts, borrowing, and guarantees. Some massive changes in this area. Also, an assessment, a long overdue assessment by some people of the leverage risks associated with the increasingly opaque nature of the private capital market, and also the correlation risks in terms of the interrelationship between the so-called shadow banking sector and the traditional better regulated banking sector. The hidden leverage pockets, which are hard to identify, to quantify, which come about as a result of the growth in family offices, hedge funds, who don't have the same degree of reporting requirements. Now, I think next week the FSB is going to be issuing its first major review of the whole shadow banking sector and proposing some generic level measures that need to be taken by the various world parties to deal with the growing shadow banking sector, which today represents something like 57% of all transactions that occur across the globe are conducted by the shadow banking sector. Not all of it's bad, and clearly the European Union wants to try and capitalize on some of the virtues of the private credit and private equity markets to fund the innovativeness and the competitiveness of European industry. So a balance will have to be found. At long last, long foreseen, but not very assertively expressed by many member states in Europe for many, many, many years, some would say even 70 years, an explicit recognition that defense spending needs to take place. And that investment in defense is actually a driver for competitiveness, which boosts R&D, innovation, with also a role for private investment supported by the European Investment Bank. And last but not least, inevitably, predictably, strategic autonomy. This is an issue you've heard me speak about in the past, which has now grown in much more importance in terms of ensuring that the European industry, the financial services industry, it has a strategic autonomous position compared to some of the other big financial service players elsewhere. Next slide, please. So as we move into a couple of very detailed areas that I'd like to touch on, one of the areas that I am particularly concerned about is the whole area of the Digital Operational Resilience Act, which has now been is now in place. It's a regulation, it's now applicable since the 17th of January of this year. Now, I think financial institutions are still struggling with this. A couple of very clear messages here. Number one, if you're continuing to use cloud services where the data is being stored and processed outside of the European Union, and if those third-party service providers of an ICT nature are supporting your critical and important functions, you will find that the regulators will ban you from doing so going forward. So be very clear about this. There is a ban on the use of third-party, third-country ICT providers who do not have a physical presence or don't have an arm, at least in one EU member state, that provide and support your critical and important functions. Something like 78% of financial institutions in Europe, according to the ECB figures, actually back up a lot of the data in cloud services, and it's estimated that maybe a third of those are based outside of Europe in jurisdictions that have no memorandum of understanding signed between the EU, no exchange of information protocols. So you can see the concerns in an increasingly interrelated world of technology, how important and critical this can be. A very important aspect, or two important aspects. One is the need for all financial institutions to renegotiate from scratch contractual arrangements with ICT providers, whether they're based in Europe or they're based in Timbuktu. And a number of very prescriptive elements need to go into these contracts, such as detailed descriptions of the services, contingency plans, the rights for ongoing monitoring, exit strategies should something go wrong, and guaranteed plans for migration to other providers or in-house solutions should there be a major mishap or incident that switches off the entire ICT process within the organization. I think the other important issue that you need to ask also is just how critical are your ICT providers? And you won't have to work this out all by yourself. The combination of ESMA, EIOPA, and EBA will have discretionary powers to designate individual ICT providers as being critical or non-critical based on four criteria. Very simply, the over-reliance on systematic impact of a provision of financial services should that particular third-party service provider fail. What would be the impact? Secondly, the systemic importance of those same third-party providers providing also services of a similar nature to systemically important financial institutions in your own jurisdiction or across the 27 EU member states. What happens if they fail? And the reliance on many financial entities to support critical and important functions at bank, fund management, and insurer level. In other words, the more reliance you have or you place in a single or maybe three or four, as happens to be the case, ICT providers who are providing everybody with in support of their critical and important functions is a vulnerability factor that needs to be taken into account. And of course, the degree of substitutability of the TPP. Should that particular ICT provider collapse overnight, that is, who's based, let's say, in some other part of the world, do you have a plan B? Do you have a substitute in place that can kick in and become operational within 24 to 48 hours? I think the question you need to be asking yourself, two major questions. One, where is your data stored and processed? And you might be surprised at the answer to that. Secondly, is your third-party ICT provider systemic in its own right? Next slide, please. And just to underline this particular concern, you will have some very rigorous incidents reporting to make to the local regulators, which is based on some very hardwired criteria, such as the number of affected clients, which if it exceeds 10% of all clients, you have a big vulnerability factor. But probably the two most important criteria for me is the reputational damage, which the Commission have hardwired into the legislation. The duration of an incident that exceeds 24 hours is considered to be a major incident and should be immediately reported to the local regulator, with some measures that need to be put in place in the coming hours. But more importantly is the duration of a incident and downtime that exceeds 2 hours if the ICT provider is supporting, as typically is in many cases, is supporting very critical and important functions within your bank or your asset management company. So the 2-hour, the 24-hour criteria are really important, and they need to go into the standards performance contract that you will have to negotiate with all of your ICT providers, no matter how big or small they may be. Next slide, please. The other big issue on the agenda is this new initiative launched by the European Commission under the new commissioner, former Portuguese finance minister, which we now call the EU Savings and Investment Union. We no longer refer to the Capital Markets Union. And all of this is designed to scale up and encourage and incentivize EU citizens to hold more savings in capital market instruments, but also providing them with the safeguards, providing lower prudential capital charges for non-banks to be able to invest in EU industry. But there are some interesting issues in concerning citizens. How can we encourage, galvanize citizens to release part of that 13 trillion euros that are in bank accounts and could be used usefully, redeployed to invest in European industry, notably startups and SMEs. So there have been a couple of issues reflected in the EU retail investment strategy, which will have amended PRIPS and UCITS and AFMD. A couple of very important indicators. One is the value for money. Now manufacturers and distributors of products will have to carry out a value for money assessment before they launch a new financial product anywhere in the 27 member states, based on a comparability of products of a comparable nature in the same market. Secondly, client screening will be relaxed to a certain extent. However, there will still be a situation where, in the case of execution only transactions, in other words, you're not asking for advice, you're asking your bank to buy $300,000 worth of gold or silver, there's still a need for a suitability assessment, which means the banks and the brokers will still have to check out the client's knowledge and the experience, and not their appetite, but their experience and the knowledge of the financial instruments that they're investing in, and an appropriateness testing for those who wish to indulge and buy into some more complex products, which means you need to understand the financial literacy skills of your clients before indulging in doing so. The other big change here is the lowering of the wealth threshold. This has been long overdue. The United States moved into this space 30 years ago. We're now lowering the wealth threshold from 500,000 to 250,000 to designate anybody who wishes to do so to become a wealthy, high net worth, as it were, or at least a professional client, which means considerably less due diligence. And inducements, another very controversial issue across Europe. Basically, binary situation here. Are we going to ban inducements entirely? as has happened in the United Kingdom and in the Netherlands, or are we going to stick to the German, Franco-German approach that this is necessary to provide advice, even if it's on an execution-only basis? But clearly, we've got two very diverse approaches to this emerging at the moment in the negotiations. One from the MEPs, that they should be banning trailer fees for investment services if they're only transmitting orders or not providing advice. And the Council taking an opposite view, saying we need to introduce an inducement test at back office level, and it's not a client-facing test. So some still outstanding issues. The Commission has warned both the European Parliament and the Council, we need to reach an agreement on this whole package in the autumn, otherwise we will withdraw the entire package. Next slide, please. The other major issue coming up on the EU Savings and Investment Union is the whole notion of creating larger pools of capital to support industry. Now, a couple of issues, interesting issues here. One, the reviewing the prudential treatment of exposure of so-called patient capital investments in SMEs and small caps by institutional investors, banks, insurers. In other words, there's going to be a reopening of the prudential rules to make it less onerous on these particular institutions to be able to invest more eagerly. Secondly, upgrading the current European Venture Capital Fund by offering and widening the voluntary EU-wide marketing passport, which is a massively important vehicle in my view. It's increasingly difficult to buy and cross frontiers when it comes to selecting investments for a range of reasons. But this particular venture capital fund with a passport will enable, I think, a scaling up of this ambition. Ensuring the full implementation of the EU Listing Act. Now, what this has done, it has allowed, or it has removed essentially restrictions on companies who launch IPOs to issue multiple voting shares. Now, we're going back on a traditional orthodoxy in Europe, one share, one vote, but actually you can hold on to multiple voting shares as a means of continuing to exert control of the company. The other issue is removing operational barriers for cross-border group of asset managers who complain that they still face massive due diligence at the local, national level. Also simplifying due diligence for securitization. That's just been launched, by the way. There will be some really interesting, and there are indeed some really interesting diminished levels of capital charges with regards to securitization, which I think will please certainly the banks. Institutional investors are slightly more concerned about some of the terms of this, but put it in the context. Last year, Europe, the annual issuance of securitization was less than 0.3% of GDP in Europe, where in the United States, it's like 5 or 6 times that. So we are looking at this new piece of securitization, a piece of legislation, which introduces more sense of risk into the system, a recalibration of the prudential charges, and it's currently being discussed as we speak between the European Parliament and the Council. And last but not least, yet another contentious issue. When are we going to have an US-style SEC in Europe that covers all of the non-banking sector industry? Well, we're very, very divided in Europe. A lot of the small to medium-sized jurisdictions in Europe are not happy about the powers that could be exerted by a single common regulator that covers all of the securities and securities and investment markets. There are others, like the French, who want to see ESMA being transformed into an EU SEC type of structure. Where we are at the moment is at least looking at a perhaps EU common harmonized regulator that would have a single supervisory powers over significant cross-border asset management or market firms where they have cross-border activities of a significant nature. Also new or emerging sectors such as crypto asset providers and key trading platforms. At least if we get those three encapsulated in a new SEC type of structure, there is there's some massive virtues to be delivered in terms of more consistent harmonization, interpretation, and less, as it were, gold plating and late transposition of legislation. Last slides, please, and I think we will end on this note. Just to say very quickly, some really game-changing changes to the ESG sustainability disclosure regime in Europe. I think, there was a massive level of protests across industry, not just in financial services, in terms of the onerous, costly nature of the CSRD, the CSSDD, the taxonomy regulation. So what we're looking at the moment today, the rapporteur, a certain Swedish EPP member, Jörgen Warborg, has come up with some very game-changing, in my view, measures that would help to facilitate and remove huge swaths of corporations, largely small to medium-sized corporations, from the need to provide disclosure on their ESG policies. And what he is coming up with is a standardized common threshold of turnover of 450 million and in excess of 3,000 employees. Beyond that amount, corporations will have to apply the EU ESG sustainability disclosure regime, which in itself is going to be subject to some simplification measures. And this would greatly, significantly reduce the number of companies in the scope to only those very large, globally active firms. Another area that I think is important is the postponement of the application of much of the legislation to 2028, which gives us all a little bit more time. Due diligence will only be related to the direct business partners. In other words, there was a proposal that companies would have to report on their ESG due diligence obligations in terms of the layers within the supply chains. Now we're reducing it to only the first layer in the supply chain, so-called tier one suppliers, and not going beyond this in terms of providing risks of human rights abuse or environmental harm at further groups in the supply chain. It will only relate to the direct suppliers of those particular corporations. And another helpful, I think, measure is full subsidiary exemption from the sustainability reporting rules to avoid double reporting if the parent company is already publishing group-wide sustainability data. So I think on that note, I will pause. You will have, of course, these slides provided on the Zen website after this particular presentation. Thank you. Back to you, Michael.
Well, thank you, David. I'm afraid we've not got more than about 10 minutes, but we've got quite a few questions here. I know you have a lot to get through, and we do appreciate it. So let's crack on very quickly. Terry Downing has a very important point, I feel, here. He's looking at all of these regulations, particularly to do with IT. How does this work for a lot of the modern entrants where their business operating model, their cost model is based on using XaaS? That's, anything, everywhere, and all the time, all at once. And these are coming in outside of the EU from offshore platforms, using the cloud, obviously, which is the way that anybody who's sensible will be handling it. So what does that mean for European financial services?
Well, a lot of this falls within the DORA framework. You can buy, for instance, software from a supplier in China, India, South Korea, and it will still have to be vetted under the terms of DORA. If it supports a critical and important function within the financial institution, the DORA regulation stipulates that particular South Korean, Indian, Chinese provider of that software has to have a physical presence somewhere in the 27 new member states. Otherwise, you will have to discontinue that relationship with that particular third party, third country provider. It's as simple as
Yeah.
that. There's no ambiguity there whatsoever.
Wow. Astonishing. I mean, Terry goes on and he points out that, the third party risk management in the EU is just a nightmare under the DORA ICT mapping. And if you're going to go down to actual service layer provision that's required, this is several layers down. I mean,
Yeah,
think about just including Google Maps or something. I know Google's in the EU, but you know what I mean? It's like, wow,
yeah, yeah,
this
yeah.
is terrifying. Yeah, that's intriguing. Had a question here, if you don't mind, from Nikki Holzhausen. Wondering if you could comment on the impact of the EU's AI Act and the financial services industry. Is that being talked about in
Yeah.
Brussels?
Yeah. Obviously, it's a transitional application of the AI Act. This coming August, from memory, there will need to all firms that use AI platforms will have to adhere to a code of practice, particularly if they're not considered to be a danger to the public at large. But look, the issue here is that the European Commission is reviewing the AI Act specifically in relation to financial services, realizing that a generic AI Act is probably not a best fit for many of the very complex issues that financial services firms have to face. So we need to wait a little bit, maybe till September, when the Commission will be issuing further, what I suspect will be guidance. I'm hoping it's not going to be yet another delegated act, but some guidance as to the use of AI platforms specifically as it relates to financial services. I think the only concern financial services should have is if they fall within the prohibited sectors. In other words, if they're using AI to predict, the credibility, creditworthiness of clients that fall within a certain ethnic group, that is the sort of prohibited activity that they need to be very careful they don't trip into, even inadvertently, and that will come into place in fully fledged by the end of 2026.
Okay. Switching ground a little bit, we do have a large domestic UK audience as well. Richard Priest is curious, how do these proposals for increasing finance for investment compare to those proposed in the UK? So we've had the Mansion House Compact, the Mansion House Accord, and we've
Yeah,
also had the tabling of the pension scheme bill a few weeks ago.
yeah,
Where are the gaps and
yeah,
challenges?
yeah. Well, actually, I was about to say that earlier, that there's a remarkable degree of commonality and not much overlap between what the UK is setting out to do and what the EU is setting out to do, which is again to encourage citizens to buy more equities. I mean, the figures in the United Kingdom is, what is it, 8% of citizens directly hold equities. That figure is 4 times more in the G7 countries and considerably more in the United States. I mean, 2/3 of US citizens, as it were, investment holdings are not in bank accounts. They're in equities and other capital market instruments. So the idea is to look for the appropriate calibration, which is, by the way, what the Swedes have done. The Swedes have a particularly interesting, successful equity culture through a combination of calibrated investment advice, which doesn't cost a fortune, accommodating tax policies, and also Swedish recognized, identified, accredited, labeled investments, which is exactly what the EU is pursuing at the moment. It wants to come up with an agreement on a small group of EU retail investment product labels that the citizens can attach certain importance and confidence to. Also, they're trying to deal with divergent tax treatment across frontiers for retail investors, although I think that's going to be very, very difficult. But also they need to deal with inducements. we need to come to an agreement on this. Either we ban inducements entirely, which is unlikely in my view. It will probably be retained for complex, highly complex products like crypto assets or maybe gold, the illiquid form of investments which are complex that citizens don't understand. And don't forget, Europe, unlike in other parts of the world, we have this awful legacy where something like 84% of EU citizens are considered by the European Commission's recent studies as being financially illiterate. And that's kind of worrying. So there is need to find that, that calibration between an adequate, not overburdensome, as it were, consumer protection regime, but at the same time opening up the equity markets to private retail investment, as it were, investment going forward. For the
I've got
longer
two
term,
comments here from John Kirsten. One taking further forward what you said is if we agree that Europe needs to mobilize its 13 trillion euros in private savings to fund innovation, resilience, and defense, the EU is going to have to reconcile this imperative with investor protection doctrines and still treat our retail capital market participation as something to be feared rather than encouraged. I see that as very much an overall arcing thing. But John goes on, and he has a specific question. Over here we're having a lot of discussion about the pension scheme bill, which has a very disturbing reserve power in it for defined contribution savings programs, which basically would say if you park your money in Britain, it might establish a dangerous principle the government can direct to that investment. That's our local discussion. But we also had, of course, Section 899 in America, which was pulled a week ago yesterday from memory. From the One Big Beautiful Bill, but it was equally terrifying, 5, 10, 15, and even up to 20% retentions on dividends and profits for companies that came from unfair tax countries, which includes digital services tax and, of course, the VAT, which Trump has declared to be unfair. So John's question, as the U.S. weaponizes financial and trade tools in increasingly erratic ways, they could always bring 899 back. How can the EU regulation evolve to ensure that Europe's capital markets and strategic industries are insulated from extraterritorial pressures, yet without simply building a fortress Europe? Can you see a resolution to that?
Well, I think the issue was very clearly articulated by both Mario Draghi and Latte in their respective reports about the need for the figure that was cited was 800 billion euros per year of investment over the next, whatever it is, 7 to 10 years. And that funding clearly, primarily in the eyes of the European Parliament and the Council members, must be generated indigenously. In other words, it must be generated in Europe itself. And that's where this 13 trillion euro issue comes in. We need to galvanize and encourage people and rechannel those funds under controlled conditions into industry. But at the same time, I think John has raised this very important point, which I fear as well, is that if we're not careful, we will raise a Fortress Europe type of scenario where, let's be clear about this, American banks are still very prominent on mainland Europe, massively investment. They do contribute to the funding of the real economy. And there needs to be, I think, an equal partnership in Europe. And part of the problem we have in Europe, of course, is that we have pretty small scale banking and fund management sectors. And what disappoints me is, the opposition from many member states in Europe to encouraging more mergers and acquisitions, which would create the basis for bigger European banks and bigger asset management firms that would have the leverage to be able to invest and raise funding like the US does. So, clearly both have to be taken into account. But, the priority at the moment, at least from the Brussels perspective, is we need to build our own indigenous funding model based on bigger, more capacity building financial institutions that can fund armaments, that can fund innovation, that can fund the future eventual pensions. And the other thing I would mention is this: unlike the United Kingdom, all of mainland Europe has lived for the last 70 years with some very generous pension and social welfare systems, which are creaking with the aging population. So visibly, this is also another element that has to be taken into account. The encouragement of citizens to fund their future pension liabilities is also going to have to be, and that can only be done through the building up of indigenous funding, as it were, entities from the European Union itself. So therefore, we need to remove some of the major obstacles we have at the moment to cross-border funding, cross-border mergers and acquisitions. We need to come up with an insolvency regime that's acceptable to all of the 27 EU member states, which is not the case at the moment. And we also need to perhaps consolidate some of the trading platforms as well in Europe. It's not normal that we have, whatever it is, 32 trading platforms. Maybe 5 would be sufficient.
Great. David, we've come past the end of time, sadly, and I can see some of the thanks flooding in here. People using their emojis and whatnot to say thank you for your insights. We really, really, really do appreciate it. As you can see, we also appreciate our sponsors who allow us to do this. And it's really quite a refreshing blast to hear many of the similarities both in Brussels and here in London. It's almost like we live on the same continent. So it's very, very good that we see some of this convergence in terms of what the issues are. I guess it's a little bit sad that some of this is being driven by conflict as opposed to just wanting to do well. But nevertheless, it's going in the right direction in so many ways. Speaking of the right direction, and I'm not referring to the band, our forthcoming events are here in front of you. At the end of the month, we have a really interesting opportunity to see inside another area of potential conflict. We're going to be looking at Taiwan's sustainable finance transformation. And then there'll probably be an event or two during August, but at the moment, the next one lined up in September is an environmental data meets financial risk. And of course, we then move into index season with the Global Financial Centers Index, Smart Centers Index, Global Green Finance Indices, as well as many other events that are coming up. I'd like to thank David for his insights as ever. It's wonderful to have him as a regular on our programs. I'd like to thank you, the audience, for your participation. It really is appreciated, and we look forward to seeing you at our next FS Club event. Thank you all.